to share a recent case study with you on how powerful the all-in-one loan can be. You'll find a link to the full case study in this post, but I wanted to highlight some key points. A middle-aged couple, both in their 50s, had refinanced in 2021. And because they had locked in a low rate, they figured, that's it, we're done with mortgage planning. But when they started looking seriously at wanting to retire in 10 years, that $2,700 monthly payment started to feel like a problem. With 27 years left on the loan, those payments would stretch until the husband turned 80. Lucky for them, their financial planner suggested they look into the all-in-one loan. In their case, with the all-in-one loan, they would be out of mortgage debt in just 8 years. Their mortgage would be paid off in 97 payments, and they would save $182,000 in interest. Think about it. Instead of paying until he turns 80, they will be mortgage-free by the time he is 61. Looking at this, you may say it's too good to be true. What's the catch? I get it. Looking at this, it seems like magic or trickery, but it's really just math. Let's dive a little deeper into their situation. In their case, their monthly deposits were close to $20,000 a month. Their average monthly expenses were $12,000, which left 18% of their net income. With the all-in-one loan, they can put that to use by having it hold down the balance of their mortgage and therefore reduce the interest costs until they need the funds. They also had $81,000 in a bank account as an emergency fund where it was earning very little interest. Moving that into the all-in-one loan allowed them to still have easy access, but put the funds to use, saving them interest costs. Thanks to the all-in-one loan, they were able to significantly accelerate the payoff of their home, improve their monthly cash flows to facilitate their needs and lifestyle. It provided a safe and efficient storage place for their money, where it was saving them significantly in interest until they needed it. It allows for 24/7 access to those funds should they need it for emergency or if an opportunity comes up. And this is very important, particularly for them approaching retirement. It provides a buffer asset for them, so they can use it to mitigate tax liability and to protect against sequence of returns risks. This couple was initially concerned about giving up their 3.75 for a higher rate loan. But remember, mortgages are a math equation, and rate is only one part of that equation. Potentially more important is the time in debt and the amount borrowed. This is what we call 3D mortgage thinking. You can see that despite having a higher rate, because of how quickly the loan is paid off, the effective percentage rate is 1.6. Looking at this chart, you'll see the all-in-one loan principal balance. You'll see that immediate drop when they put in that amount that was sitting in their savings and then going down to be paid off in 8 years. You'll also see that even though it's paid off, they still have access to that line. So again, throughout their retirement, should they need to draw funds from that, they could. And then the green line, of course, is their traditional mortgage and how that looks over the next 30 years. So I hope this was helpful for you. Please reach out if you'd like to see your own scenario or what your numbers will look like, or just to dive in more and learn more about the all-in-one loan.